2 months ago, when Bitcoin was falling, when altcoins were bleeding, and when the entire crypto market was flooded with predictions that the cycle was over, Raoul Pal posted something that almost nobody wanted to hear. He wrote, "The crypto cycle is not over. That is an alluring narrative trap reinforced by continued daily price declines." At the time, that statement looked wrong. Bitcoin had dropped from the $90,000 range into the low 60s. Funding rates were negative, sentiment was collapsing, and the dominant narrative across financial media was simple. The bull run had ended early. People mocked the idea that the cycle was still intact. But now, only weeks later, the global situation has changed in a way that makes that warning look less like optimism and more like macro analysis. We are now more than 2 weeks into a full-scale regional war involving the United States, Israel, and Iran. Oil prices have surged above $100 a barrel. The Strait of Hormuz remains unstable. Strategic reserves are being discussed. Defense spending is exploding. Global markets are under pressure. And in the middle of all of this, Bitcoin is rising. It has pushed back above $74,000. It briefly broke $76,000. Short sellers are getting squeezed. Funding has stayed negative for nearly 2 weeks straight. Institutions are still buying. That is not what a dead cycle looks like. And if you understand Raoul Pal's framework, what is happening right now may be exactly what he warned about months ago. The moment when global liquidity turns higher, even while the headlines look worse than ever. Because this did not start with the war. This started in September 2025 at a private global macro investor masterclass where Powell made a prediction that sounded extreme at the time, but now looks almost unavoidable. He said, "This is the 12 months where maximum money printing comes. The biggest macro variable of all time is that global governments and central banks are increasing liquidity to manage debt at 8% a year. That was before the war, before oil spiked, before the refinancing crisis hit the headlines. But his thesis was simple. The global system has too much debt, too much refinancing coming due, and not enough growth to pay for it without printing money. And once you understand that framework, the question is not what the Fed says tomorrow. The question is whether the world can avoid the liquidity wave that Powell says is already underway. And right now, every signal in the system suggests the answer is no. If you are new to the channel, subscribe and turn on notifications. This is not hype. This is macro analysis, and the next few days could be some of the most important of the entire cycle. Let's break down what is really happening. Raoul Pal's entire thesis about this cycle starts with one number that almost nobody outside the macro world is talking about: the global debt refinancing wall. Between 2025 and 2027, governments around the world need to roll over roughly $9 to $10 trillion in sovereign debt, not issue new debt, refinance existing debt. That means bonds that were issued when interest rates were near zero now have to be refinanced at rates that are 3, 4, or 5 times higher. For governments already running massive deficits, that is not sustainable. And that is why Powell said the most important macro variable in the world right now is not Bitcoin, not inflation, not even interest rates. It is liquidity. Because when the system cannot afford the cost of its own debt, there are only 2 options: default or print. And modern governments do not default. They print. That is exactly what happened after the 2008 crisis. It is exactly what happened during COVID. It is exactly what happened during the Iraq War era when deficits exploded and monetary policy stayed loose for years. Every major crisis in the modern financial system has ended the same way, with more liquidity. And now, the war in the Middle East is accelerating the exact conditions Powell warned about. Oil has surged past $100 per barrel as markets price in the risk of an attack on Iran's Karg Island, the hub that handles nearly 90% of Iran's oil exports. If that infrastructure is damaged, millions of barrels per day disappear from the market overnight. The International Energy Agency has already discussed coordinated releases of up to 400 million barrels from strategic reserves, but even that may not be enough, because the real bottleneck is the Strait of Hormuz. Nearly 20% of the world's oil passes through that narrow waterway, and as long as the conflict keeps it unstable, energy prices stay elevated. High oil prices do not just hurt consumers, they force governments to spend. Subsidies, relief programs, military budgets, emergency stimulus, all of that adds to deficits, all of that increases borrowing, and all of that eventually leads to the same place: more liquidity. This is exactly why Powell said the next 12 months would be the period of maximum money printing, not because central banks want to print, because the system requires it to survive, and the market may already be starting to price that in. Look at what Bitcoin is doing right now compared to traditional markets. While equities have struggled under the pressure of higher oil prices and war headlines, Bitcoin has pushed higher for 3 straight weeks. It broke $74,000. It tested $76,000. Short liquidations have dominated the tape, with hundreds of millions wiped out as bearish positioning gets squeezed. Funding rates have stayed negative for nearly 14 days, the longest streak since the December 2022 bottom. That matters because extended negative funding means traders are positioned for downside even while price stabilizes, and historically, that combination often marks the end of corrections, not the start of them. At the same time, institutions are behaving exactly the way Powell's liquidity model would predict. Michael Saylor's company added more than $1 billion worth of Bitcoin this month alone, even with price still below his average cost. BlackRock has moved forward with new crypto products, including staking-related structures tied to Ethereum. Tom Lee's Bitmine fund disclosed tens of millions of dollars in Ethereum purchases during the recent pullback. These are not the actions of investors who believe the cycle is over. These are the actions of investors positioning for the next phase of liquidity expansion, and this is where Powell's second point becomes critical. He has repeatedly said that global liquidity has had roughly a 90% correlation with Bitcoin since 2012. Not the halving, not the news cycle, not sentiment, liquidity. In his latest update, he explained that global liquidity is still growing around 10% per year, financial conditions are easing, China is expanding its balance sheet again, and bank credit creation is rising as regulations loosen. He also pointed to something most traders never think about: tax refunds, bank balance sheets, and regulatory changes like the ESLR that allow banks to absorb more treasury issuance. All of those increase the ability of the system to create credit, and credit creation is liquidity. Even the recent pullback, according to Powell, came from a temporary drop in U.S. total liquidity that tends to lead crypto by about 3 months. That drop has already reversed, which means the lagging effect should now be turning positive. And that brings us to the moment everyone is watching right now, the Federal Reserve meeting. The Fed decision tomorrow is being treated like the most important event for Bitcoin, but according to Powell's framework, the rate decision itself may not matter nearly as much as people think, because liquidity does not only come from rate cuts, it comes from deficits, it comes from treasury issuance, it comes from central bank balance sheets, it comes from bank lending, it comes from fiscal spending, it comes from energy shocks that force governments to intervene. And right now, every one of those forces is pointing in the same direction. The U.S. deficit is still massive, the refinancing wall is getting closer, war spending is rising, oil prices are elevated, strategic reserves are being used, China is easing, banks are expanding credit, stablecoin supply is growing, crypto regulation is becoming clearer. This is exactly the environment Powell described when he said maximum money printing was coming. Even if the Fed does not cut tomorrow, the system still needs liquidity, and history shows that when the system needs liquidity, it eventually gets it. That is why the current sentiment in the market looks so strange. Fear and greed has stayed near extreme fear levels, even while price stabilizes. Funding has stayed negative even while Bitcoin rallies. Retail sentiment is still convinced the cycle is over. That is exactly what Powell meant when he called the bear narrative an alluring trap, because the trap is not the price. The trap is believing that the macro cycle has ended when the liquidity cycle has not, and right now, the liquidity cycle looks like it is just getting started. When Raoul Pal warned in February that the cycle was not over, almost nobody believed him. When he said in September that the next 12 months would bring maximum money printing, it sounded premature. But today, the pieces of that thesis are lining up one by one. A global debt refinancing wall that cannot be paid without new liquidity. A regional war pushing oil prices higher and forcing government spending. Strategic reserve releases and fiscal stimulus discussions already underway. Institutions buying while sentiment collapses. Negative funding while price rises. Financial conditions easing even as headlines get worse. And now the Fed meeting arrives right in the middle of it. Whatever the Fed says tomorrow, the bigger trend may already be locked in. Because liquidity does not move on a single rate decision, it moves on the structure of the global system, and that system still has too much debt, too much spending, and too little growth to function without printing money. Powell said the cycle was not over. He said the narrative was a trap. He said the next 12 months would bring maximum liquidity. The war is creating the conditions for it. The debt wall requires it. The market is starting to price it. The only question left is whether investors recognize it before the next move begins. If you found this breakdown valuable, like the video, subscribe to the channel, and leave a comment telling me what you think the Fed decision will do to Bitcoin, because the next few days could decide how the rest of this cycle plays out. Thanks for watching, and see you in the next one.